Welcome back to the Deep Dive. Today, we are taking a close look at one of the giants, Alphabet Inc.
Yep, we've got their Q2 2025 financial blueprint right here. This is straight from the 10Q filing for the 6 months ending June 30th.
Our goal here is, to cut through all that dense financial language. We want to highlight the big trends, the strategy shifts, and frankly, the risks you can see just by looking at how they're spending their money.
Exactly. Forget just the quarter-to-quarter noise. We're looking for the bigger picture, where this ship is really heading.
And right off the bat, looking at the cash flow, there's this fascinating tension. We're kind of calling it the great dichotomy.
Explain that.
Well, on one hand, you've got this incredible money machine. They generated, wait for it, $63.897 billion in cash from operations just in the first 6 months of 2025.
Just staggering operational efficiency.
Yeah.
Pure profit generation on a scale that's hard to even comprehend. It really shows how strong that core advertising and now cloud business is.
But here's the other side of that coin, the dichotomy. They are absolutely not just sitting on that cash.
No, they're spending it almost as fast as it comes in, setting records for capital expenditures.
We're talking $39.643 billion spent acquiring property and equipment, CapEx, in that same 6-month window.
That number is just massive. It's a huge jump from the year before.
Right. So they're this incredibly powerful cash generator, but simultaneously one of the most aggressive spenders out there, pouring billions into infrastructure right now.
Well, you could argue it's the cost of playing and winning in the AI arms race. They need the hardware.
They're not just counting today's profits. They're laying the foundation, the actual physical foundation for whatever comes next. AI, cloud expansion, you name it.
It's a huge bet, a massive commitment. And that's really the first thing we need to dig into.
Okay, so let's start with where the money's actually coming from. Top line revenue for the first half of 25, $186.662 billion.
And importantly, if you strip out the currency effects, because the dollar's been strong.
Right, the constant currency growth.
Yeah, that overall growth was actually a pretty healthy 14% for those 6 months.
Okay, so solid growth. And breaking that down, Google services is still the beast, right? Search and YouTube leading the charge.
Absolutely. Google search and related stuff, that revenue jumped by $10.2 billion compared to the first half of last year. And YouTube ads chipped in another $2.0 billion increase. The demand is clearly still there.
But I think the really interesting part for you listening in isn't just the big dollar amounts. It's the subtle shifts in how they're making that money.
The monetization metrics.
Exactly. Like, look at search. Paid clicks. The actual number of clicks people made on ads only grew modestly, maybe 3–4%.
Yeah, steady but not explosive growth in clicks. But, and this is the fascinating part, the cost per click, the CPC, what advertisers are actually paying for each of those clicks.
That went up way faster.
Way faster, up a full 8% over the same 6-month period.
So what does that tell you? It sounds like the ad slots aren't growing like crazy, but the bidding war for those slots is heating up.
That's a good way to put it. Advertisers are willing to pay significantly more to get their ads seen. It screams pricing power.
Okay, that makes sense. And you see a similar kind of dynamic in their network business too, the third-party sites.
Sort of, yeah. A bit different, but the same theme of quality over quantity, maybe. Impressions, the number of times ads were shown actually went down a bit, like 5 or 6%.
Oh, interesting. Down.
But the cost per thousand impressions, the CPM, grew by pretty much the same amount, 5 or 6%. It looks like they might be deliberately showing fewer, perhaps lower value ads to boost the price they get for the remaining ones.
Strategically managing inventory to maximize yield.
Okay. And then there's the move beyond just ads, the subscription stuff.
Right. Diversification is key. Google subscriptions, platforms, and devices, that whole bucket grew by $3.5 billion in the 6 months.
And that includes things like YouTube TV, music, premium.
NFL Sunday Ticket, Google One Storage. It all adds up. It gives them another revenue stream that's less tied to the ups and downs of the ad market.
Definitely helpful. But if we're talking strategic importance and future growth, we have to talk about cloud. Oh, absolutely. Google Cloud is, well, it's really the star performer right now in terms of driving margin improvement for the whole company.
The numbers are pretty stark. Revenue for the 6 months hit $25.884 billion. And the growth rate for the quarter was, what, 32%?
32%. Just huge growth. But the really big deal is that it's not just growing revenue anymore. It's actually profitable.
It finally crossed that threshold consistently.
Exactly. For the first half of the year, Google Cloud reported an operating income of just over $5 billion. $5 billion. That's
Yeah.
serious profit coming from cloud now.
And that profitability, presumably, is what's helping fund this massive spending spree we mentioned earlier.
It has to be. Cloud is becoming the engine that generates the kind of margins needed for these huge CapEx investments.
Okay, one quick thing before we pivot fully to the spending side, the geographic mix. Still mostly U.S.-based revenue.
Yeah, pretty consistent. U.S. is about 48%, EMEA, Europe, Middle East, Africa is around 29%.
But the filing did mention some headwinds from foreign exchange, right?
It did. The strong U.S. dollar basically means when they convert sales from places like Brazil, Mexico, or Australia, Korea, India, back into dollars, it looks like slower growth than it actually was in the local currency.
So an accounting issue more than a demand issue in those places?
Generally, yes.
Yeah.
It just dampens the reported international growth numbers.
Okay, let's connect those dots then. Massive growth, especially cloud profitability, needs massive infrastructure. So back to that CapEx surge, almost $40 billion in 6 months, way up from $25 billion the year before.
And the filing is crystal clear about where that money's going.
It's almost all for tech infrastructure. Servers, networking gear, building out data centers all over the world.
And they explicitly link it to.
They explicitly say it's needed to support long-term growth, especially for their AI products and services. It's right there in black and white.
So if cloud is today's profit engine, this CapEx is basically the fuel and factory floor for tomorrow's engine. They're building the infrastructure needed for things like Gemini, future AI services, and just supporting the continued growth of cloud itself. It's a really aggressive bet on the future. And interestingly, look how they're financing it.
Right. This is the part I wanted to ask you about. They're sitting on, what, $95 billion in cash and securities?
$95.148 billion, yeah.
A huge pile of cash.
So why then did they go out and issue new debt in May?
That's the billion-dollar question, isn't it? They raised $5 billion in U.S. dollar notes and another $6.75 billion, which is roughly $7.9 billion, in euro notes. So like $12.5 billion in new debt.
Even with all that cash on hand, what's the thinking there?
Well, my guess is financial engineering, basically. Management probably sees this AI-driven CapEx burn rate continuing, maybe even accelerating.
Okay.
So they're locking in potentially favorable interest rates now, using debt, to keep maximum flexibility. It means they don't have to touch their existing cash pile or worry about repatriating overseas cash if they need funds quickly for CapEx or maybe even a big acquisition.
Keep their powder dry, so to speak.
Exactly. Plus, they still have that $10 billion untapped revolving credit line. It just screams, we value flexibility above all else right now. Okay, that makes sense. So massive investment in the future, financed smartly. But they're also giving a lot back to shareholders today.
Oh yeah, aggressively. The buyback program is enormous.
How much did they repurchase?
In the first 6 months alone, $28.6 billion worth of their stock, Class A and C shares.
$28 billion. And they just re-upped the authorization, didn't they?
They did. In April, the board added another $70 billion to the repurchase authorization.
Yeah.
So they still have, get this, $86.3 billion left that they could use for buybacks.
Wow. So shrinking the share count like crazy, which helps earnings per share.
Right. And on top of that, they also boosted their quarterly cash dividend, raised it 5% to $0.21 per share, also back in April.
It's a pretty clear message, isn't it? We're spending like mad on the future, but we're so confident in our current cash flow that we can also shower shareholders with cash right now.
But
Yeah.
there are definitely some clouds on the horizon, or maybe shadows is a better word. The legal and regulatory pressure is intense.
We see the direct cost already hitting the books.
Yep.
That $1.4 billion charge in Q2's G&A expenses.
Yeah, related to settling, as they put it, certain privacy matters. That's cash out the door right now.
But like you said, the real threat isn't just the fines today, it's the potential for forced changes to the business itself down the road.
Exactly. I mean, the 10Q just reads like a greatest hits of global antitrust investigations. It's relentless.
Which one worries you the most looking at that list?
You really have to focus on the ad tech case in the U.S. There was that mixed ruling back in April, and the next phase, the relief procedures, that starts in September.
And the risk there is?
The risk there is that the DOJ is explicitly asking for structural remedies.
Okay, translate structural remedy for us. What does that actually mean?
It means breaking up parts of the business, potentially forcing Google to sell off or somehow separate key pieces of its advertising technology stack.
Wow. So not just a fine, but actually changing the structure of how they operate that massive ad business.
If the court were to agree, yes. It could fundamentally alter how their ad systems work how search and YouTube monetization interconnects, it's a huge potential disruption.
And that's just one case. The big U.S. search antitrust case is still ongoing too, right? They lost the initial ruling last August.
Correct. The remedies phase for that finished in May, but Google's planning to appeal the underlying ruling anyway, so that's still very much in play.
And then there's the Google Play Store stuff with Epic Games.
Yep, the jury verdict against Google from December 23. The judge issued a relief order, but it's currently on hold while Google appeals. But the risk is still there. They could be forced to open up their app store, change how payments work, which impacts billions in fees.
Oh, and it's not just the U.S. Europe's piling on too.
Oh, absolutely. The European Commission is deep into investigations under their new Digital Markets Act, the DMA. They're looking at Google Play and search compliance.
And they've already flagged issues.
They issued preliminary findings back in March saying they think Google is infringing the rules. So the pressure is coming from everywhere, simultaneously. It feels like the cost of doing business now includes a permanent, very expensive legal defense team.
Okay, so beyond those active legal battles, we also need to think about commitments they've made that aren't even fully on the balance sheet yet. That $40 billion in CapEx is just the start.
That's a really important point about future obligations. Digging into the notes, you find they've already signed deals committing them to a massive $23.9 billion in future operating leases.
$24 billion for what?
Mostly for data center space. Physical buildings to have all that new server and network gear they're buying with the CapEx. These leases start kicking in between now and 2031.
So $40 billion spent on equipment now, and another almost $24 billion locked in for the rent on the buildings to put it in over the next several years. It really underscores the scale of this infrastructure build-out.
It's a multi-year, multi-tens of billions of dollars commitment.
Right.
And one last thing on future spending, don't forget acquisitions.
Right. They have that Wiz deal pending.
Exactly. The planned $3.2 billion all-cash purchase of Wiz, that cloud security company, expected to close sometime in 2026. It fits right into strengthening Google Cloud's offerings.
So yeah, it really feels like every future dollar of cash flow already has a job assigned to it. Reinvestment, shareholder returns, or legal costs.
So, wrapping this all up, what's the big picture from this Q2 blueprint?
Well, it feels like a company absolutely flooring the accelerator towards the future. That AI infrastructure build is clearly priority number one.
Yeah, full speed ahead on CapEx. But at the exact same time, they're navigating this minefield of regulatory threats that could potentially force fundamental changes to how they make money.
The core contract is just so stark. They've never been more profitable, generating unbelievable amounts of cash.
Unprecedented cash flow. But they're also deploying that cash faster than ever before. And a lot of that spending feels almost mandatory. Now you have to keep up in AI, you have to pay the legal settlements.
Okay, so here's the final thought we want to leave you with, something to keep an eye on over the next year or so.
Given the absolutely enormous scale of this investment, nearly $40 billion spent already, plus that $24 billion in future lease commitments locked in.
How quickly does the growth in Google Cloud and whatever comes out of these new AI services, how quickly does that need to translate into even higher profits? How soon does that massive spending need to show serious operational leverage to justify itself?
That's the multi-billion-dollar question, isn't it? The timeline for seeing a clear return on this historic CapEx investment. That's what will really tell us if this incredibly aggressive strategy pays off. Was it brilliant foresight, or did they jump too soon, too big?
Something to track for sure. Thanks for diving in with us today.
We'll catch you next time.